one of the last Senate estimates I did was to talk about low returns, so I have a view that the returns are going to be lower. But about a year ago, I was asked to present at the OECD because they're worried about this topic, right? They're worried that people are going to overstretch for returns. And so I had the audience like this audience, and I said, I think returns are going to be about 6%. And you know when an audience doesn't like what you just said, you can feel it? Maybe I'm feeling it now, right? And so then I go, oh, maybe seven. And then I go, oh, perhaps 8. Right? And half the audience relaxed. You could see them physically relax, which is kind of pleasing, although even 8's a high number.
And that's total return, that's not a real return.
That's a total return, and obviously it's a generalised question to a European audience. But the reason it's so critical is because if you've got too high a number, you'll chase returns that don't exist. You'll be tempted. And to be honest, the asset management business will be tempted to sell you that stuff. And so you've got to get that number right. I did this recently with a bunch of university students at Melbourne University. I asked them for the vote. And I did a vote, I did 2 lectures. And I did the mistake the first time. I asked them, we could do it here, but I won't. But I said 2, 3, people stuck their hands up. Of course, people are slow to stick their hand up. So the next lecture I did it randomly. What was interesting was it was around 6 or 7%. This is a bunch of students. But there's a large group of Chinese students and a bunch of hands went up at 12%. And one of the problems that China's got is that people want those returns, but even in our own market, people chase these returns. So my answer is get your return sites down. Get them down because we've seen great returns because we've had a one-off revaluation courtesy of 30 years of falling interest rates. And so that's bought forward valuations. Endowments, for example, today have this problem. They don't have enough yield, and yet they've had more capital growth than they realise. In other words, the capital growth has been compensation for the falling yield, if you see what I'm driving at. And so we've had this one-off boost. And so I can give you this little insight that at the Future Fund, when we were looking at long-dated assets, in 2012, 2013, you had to make a very big decision. And the decision was, is the discount rate going to stay low for a long period of time? Because if you bought airports at a lower discount rate, you'd be prepared to pay more for them. And it turns out that was a big decision to make. But you get a one-off revaluation during that process, and you appear to get 15 or 20% returns. After that, it'll go to lower. It'll go to 6s, 5s, 7s. So my answer to the question is it's got to be low. But if we get a shakeout in the markets, if we get a cyclical correction, then you might be able to pick up stuff that's cheap in a contrarian way, in which case you can get better returns, and maybe the Magellans of the world will drive that. So my answer is maybe 6, maybe 7s. Anyone happy? 8?
Then we're not going to let you off there, because going on Wimel's comments, that process isn't over. Rates are going to go longer. And if you go back, distinctly remember everyone reading about it, talking to people, don't expect great returns. Now, if I produced that 5 years later, I could have been in infrastructure, I could have been in the NASDAQ, I could have been in certain currencies, I could have been in the Sydney real estate market like most people here. Correct. And we'd laugh at your 5 or 6%. So why is it different now?
Yeah, it's a judgment call, and so you might disagree with me. But the point is that the discount rate has been falling for 30 years. And so there's a lot of habit behind this. We've all been very lucky to be an investor for the last 30 years, basically. And I would say that from, let's say, 8, 9, 7%, that next step down in discount rate in 2012-13 was reasonable. The trouble is now that if you discount it even further at these current low rates, it starts to be because there's going to be a recession or there's something wrong with the earnings side of the discount story. So there's 2 parts to valuing something. One is how much it's going to earn, and the other is the discount rate. If the earnings generally hold up, like Melbourne Airport, as I paid for the parking this morning, right? That's got great earnings profile. If the discount rate comes down, the valuation of that goes up. But if we continue to get discount rates falling from here on in, then I think we go into recessions, and some of these asset classes have leveraged earnings to them. We've already got the highest profit share in the world in many of the corporate sectors. And if we get rates down here or even further down, it's on that tipping point where it starts to affect the earnings. And the present value of no future earnings is not much value. It doesn't matter what discount rate you use. And so that's the balancing item. We've finally reached the point of discount rate falls where it's starting to affect, it'll go lower if our growth environment is much worse.